Welcome to episode 84 of Live with the Maverick. My name is Dominic Lee, founder of Maverick Actuary. We are a content community. Our mission is to maximize the impact and value of quant professionals on a global scale. The goal of this series is to educate our community on the most relevant themes in actuarial science, risk management, and analytics. The theme of today's discussion is Defined Benefit Renaissance. And we are very excited to have with us our guest, Zorast 𝗭𝗨. Zorast is a principal and consulting actuary at Milliman, one of the world's largest independent actuarial consulting firms. So welcome, Zorast.
Hi, thanks, Dominic. Happy to be here.
Happy to have you, and just love to give you an opportunity to introduce yourself.
Sure. Well, again, Zorast 𝗭𝗨, and a consulting actuary with Milliman. I've been with Milliman for the last 22 years and have been in the pension space for the last 25. And my primary focus is on defined benefit pension plans sponsored by corporations. And I'm a big proponent of lifetime income solutions and retirement adequacy. So, certainly a big DB plan supporter. And when I'm not talking about things associated with retirement, I enjoy watching a little bit of basketball. Just finished March Madness, which was a great tournament, both for men and women. And looking forward to the NBA playoffs that is going to take place over the next month or so. So, yeah, happy to be here.
Great. So a couple of follow-ups on that, if you don't mind. So Knicks, well, two questions actually. Knicks or Nets, and then Yankees or Mets?
Well, for me, it's definitely the Knicks. Just a lifelong Knicks fan, but haven't had a chance to celebrate a championship yet in my lifetime, but still hopeful. And even though I live in Queens and I'm closer to Citi Field, I am a Yankee fan. That was passed down for generations in my family. So
if you ever want to know what a championship's like, come visit us in Los Angeles and come take a visit down to crypto.
yeah,
don't mean to rub it in.
Yeah, you guys definitely have experience with the rings. I'll give you that much.
Yeah. So I did mention that you're a principal and consulting actuary at Milliman. So how would you describe your current role there?
So primarily focused on defined benefit corporate plan valuations, coming up with minimum cash requirements for pension plan sponsors. Also, we work on accounting type valuations for clients in the private sector, where that the pension plan disclosures ends up going on their 10K financial SEC financial statements. Also play a role in pension risk management in our practice. That's been really front and center since the Pension Protection Act was passed in 2006. Essentially effective for years 2008 and onwards. I like to essentially have a focus on both sides of the balance sheet. That is, having expertise in liability valuation, but also on the asset allocation side and with respect to asset liability studies. I'm able to use, rely on my CFA charter designation that allows me to essentially speak the language of most of the plan sponsors of pension plans on the finance side. They're either MBA holders or fellow CFA charter holders. And, I think it further emphasizes my actuarial risk management background, but it also allows me to be a trusted business advisor to the plan sponsor, which is my ultimate objective. I want to help the plan sponsor to accomplish their retirement goals.
I'm glad you mentioned that, because I get the question all the time from students is, as actuaries, we get credentials, and that's how well, of course, you get educated through practical experience, but that's a part of our formal education is getting credentials. But particularly on the life side, on the investment side, a lot of actually, or let's just say on the SOA side, a lot of students will ask me if they should do the CFA. And I think you pointed out a couple of benefits of doing it. I would imagine there's never just a linear yes or no, but I think you pointed out a few potential benefits, I would say, to having that in addition to the FSA.
Yeah, I think it's certainly a useful complement on the retirement side for pension plan practitioners. For me, it had been a decade or so since I had taken since I had completed the actuarial exams. But it was a nice way for me to sort of expand my depth. And that's always nice for me, being a lifelong learner and just trying to continuously evolve. But I think also it expanded my utility and services that I could provide to pension plan sponsors, not just focusing on, sort of narrowly on what's happening to your pension plan liabilities, but sort of looking at liabilities and assets and funded status in particular. And so I think that, I found that very helpful in both enhancing my understanding and then also improving my ability to work with plan sponsors to best serve them.
Okay, makes sense. Now, the theme of today's discussion is defined benefit renaissance. But before we dig deeper on that topic, let's cover some of the basics on retirement plans. So first of all, what are the primary categories of retirement plans?
Well, I guess stepping back, we'd first start with essentially defined benefit pension plans and defined contribution type pension plans. In a defined benefit plan, as the name suggests, the benefit that the sponsor is going to provide at retirement is essentially defined in a formula, like 2% of pay times years of service, for example. In a defined contribution plan, the contribution that the plan sponsor is going to provide, or that the plan sponsor may provide, is defined in advance. So an employer could be making a 4% of pay matching contribution to a 401k plan. The amount that you're going to end up with in retirement is not known in advance, versus in a defined benefit plan, the defined benefit tries to define what you will essentially accumulate in terms of your lifetime income based on the plan sponsor's formula. Some key differences: defined benefit plans generally have to offer an annuity type option over the lifetime of the participant or the participant and spouse. In a defined contribution plan, we're used to seeing the retirement benefit in a lump sum format. And so then it's up to the participant to decide how to draw down that money in their retirement years. So that, there's some key differences there. And typically in a defined benefit plan, the employer is afforded some sort of tax exempt type status in terms of tax deductible contributions to a defined benefit plan and investment growth in the pension plan. It also gets tax sheltering, but in return for that, they have to make minimally calculated contributions under IRS rules to a DB plan. In a DC plan, you typically have employee contributions on a pre-tax basis, and you may or may not have an employer matching contribution as well. So those are some basic differences. And within the defined benefit space, which is my primary focus, there are different types of plans. There are the single employer or corporate pension plans, which is where I work in primarily. There's also multi-employer or Taft-Hartley plans, so the union type of pension plans. And then there's pension plans in the public space, for your policemen, teachers, firemen. And so, my specialty again is on the corporate side for defined benefit plans. And the rules are very different depending on where you're operating in the DB space. And in particular, as you alluded to, I think that right now we are seeing somewhat of a DB renaissance. And for me personally, it's a very exciting time to be a pension actuary in the corporate space.
That's very helpful. No, admittedly, I did actually start. Most people don't know. I started my career, I guess, technically in retirement. I mean, my first actuarial internship was in retirement, and it never went beyond that. So just kind of try to jog my memory on some of the terms you mentioned. You talked a bit about plan sponsors. So for those of us who may not be as familiar with the language of retirement and retirement plans, who are the key parties involved in a retirement plan?
Okay, yeah, good question. So, it starts with the employer or plan sponsor of the defined benefit plan. The plan sponsor is essentially creating a defined benefit plan for the exclusive benefit of the plan participants and beneficiaries. And so the employees of that plan sponsor are the participants in the defined benefit plan. And then in terms of key service providers, you have the actuary who's performing the evaluation and notifying the sponsor of contribution requirements and other types of valuations, be it financial valuations or insurance premium valuations. You have an administration team typically who is helping with the record keeping and participant disbursement of benefits during retirement. And you also have a team of investment advisors who are reporting on the financial performance of the assets that are supporting those defined benefit liabilities. And I guess in addition to that, you also have lead attorneys who are making sure that plan documents are compliant. Those are, I would say, those are the major stakeholders and service providers for a defined benefit pension plan.
That's helpful. Now, one point of clarification that might be helpful is we know that actuaries are working on valuation, and for the defined benefit plans, they're trying to help the plan sponsor with the contributions. So one natural question one might ask is, when we see you have actuaries at a consulting firm like Milliman, such as yourself, or focus on valuation, but you may also have actuaries at companies like Prudential, Vanguard, Fidelity. So what's the difference in terms of the role that you do relative to the plan compared to what someone in one of those companies would do as an actuary?
So I think the difference there is sort of highlighting the difference between really the consulting side and the insurance side. So I think the actuaries who are working for some of the insurers who might be working in the annuities type department typically are focused on the business challenges of the insurer. So making sure that their solvency requirements are being satisfied. Versus in a consulting environment, I'm typically working on the business challenges of our external to Milliman, of our clients who we serve. And so I'm essentially working on the business challenges of many different constituents versus sort of an internal facing that an annuities actuaries might be focusing on working in an insurance company. So that's how I would generally characterize the difference.
Would you also say the one difference is when they come into play? Because I know, and we'll talk about this later on with the annuity purchases, I would imagine that's when the insurance comes in. So would you say that that's a part of it as well? Is at what point within the transaction they come into play, or would you say everyone is always at the table?
Well, yeah, I think so. I mean, upon an annuity purchase by an insurance company, that's essentially when liabilities and plan assets are transferred from the plan sponsor to the insurance company. At that point in time, once that transaction is done, I would say that essentially the insurance actuary might have a more prominent role, because essentially then the insurance company becomes essentially a plan sponsor, if you will. They're on the hook for paying out the benefits over the lifetime of the plan participants. But that's not to say that that's generally the case, because it all depends on whether that transaction takes place, which ultimately depends on the risk tolerance of the original plan sponsor.
Okay, great. And we'll talk about the annuity purchase in more detail further on. Now, one interesting responsibility that you have in your role at Milliman is you author Milliman's corporate pension funding study. So how do you describe this study?
Yeah, so the Milliman Corporate Pension Funding Study looks at the funded status of the largest 100 plan sponsors in the defined benefit space. It's an annual study. We've been doing it since the year 2000, so at the turn of the century. And essentially, we are reporting the information. We're collecting the information that's reported on the 10K SEC financial statements. We are consolidating that information and then essentially making observations on trends and essentially the financial health of the largest pension plan sponsors in the US. We also have a pension funding index that we release on a monthly basis. And that's where we take the results from the pension funding study and we aggregate the results of these 100 plan sponsors. So essentially, like, we're tracking the results of one ginormous pension plan, assets and liabilities. How are they changing from month to month? How are interest rates, corporate bond interest rates affecting the prevailing liability valuation? And then we look at indicative asset indices that are, that would be representative of how these 100 largest plan sponsors are invested for their pension plan assets. And then that's how we also track the performance of plan assets. And so, we've been tracking this over time, and we've seen, various periods of sustained underfunding, and then, crossing that 100% threshold, only to then fall back again. So it's been over the last 2 decades, it's been a little bit of a roller coaster ride. But I'm happy to report that just based on our April funding index just released last week, right now corporate pensions are funded just north of 105%, which means that we are in surplus territory finally, which is a big change from what was seen over the last decade.
So when you talked about the funding ratio, is it essentially, I'm just kind of going to guess here, a rudimentary guess, is it essentially just like the present value of assets over the present value of liability, or is there more to it than that?
Yeah, no, that's exactly what it is. It's assets divided by the present value of liabilities. Yeah.
Yeah. No, I want to actually loop back to something that we spoke about earlier. You talked about some of the different, I know that corporate pension plans is your specialty, but one of the things I read in the article was that I think it's public pension plans face an estimated $1.45 trillion in funding gaps, or there's a $1.45 trillion funding gap. So I guess the natural question is, who's going to pay that? Is it going to be taxes, or, I mean, there's just not, I don't know, printing more money? I don't know.
Well, well, the short answer is us, but the taxpayers certainly contribute to any deficits in the public pension space. But just as some additional background, I mentioned earlier that the rules are very different for corporate plans versus public plans, and so on the public plan side, the use of the discount rate, which is essentially the measure that is used to calculate the present value of liabilities, that's the interest rate measure. The interest rate on the public plan side, you're allowed to use an interest rate that's based on how your assets are invested. So the more heavily you're invested in equities, you can command a higher rate of return, a higher rate of expected return, and then you can in turn use that interest rate to value your liabilities. And so there is a benefit to investing in equity type instruments, and with equities comes, of course, volatility. And for public plans, I guess the required contributions are not as heavily regulated as they are on the corporate side. So you can see some public pensions with a significant deficit at times. and ultimately the deficit does fall upon, it could very well fall upon the taxpayers of that community. On the corporate defined benefit side, discount rates are based on a corporate bond yield curve measure. So it's essentially independent from how the plan assets are invested. So there's no longer this tremendous incentive to invest heavily in equities in order to command a higher rate of return and thereby perhaps reduce your liabilities. On the corporate side, because the asset and liability valuations are somewhat disconnected, there's more of a focus on funded status measurement versus asset maximization or return maximization. And so that's where you get into the risk management strategies that look at both sides of the balance sheet. And that's where you get into the proper asset liability matching discussions.
Oh, very helpful. Now, it's no secret that when it comes to defined benefit plans, when you look at the arc of history, that when I say they fall into favor, they've just become less common. I mean, if we look at it empirically, I looked at in the same article, it said that, I think it said 1% of wage earners and salaried workers have a defined benefit plan. Only 41% have a 401k plan, a defined contribution plan, and then I think it said 8% have both. However, as you mentioned earlier, that or you alluded to, recent environmental changes have shined a light on the importance of defined benefit plans. What were the drivers of of those changes? What some of those environmental changes, or what were some of those changes?
Yeah, well, certainly over the past 2 decades, we've seen corporate defined benefit plans, reduce in the number of size and the number of participants being supported under the DB system. We've seen that either through plan freezes or plan terminations. That's when you fully transfer all of your liabilities to an insurance company. And we haven't seen the growth of defined benefit plans, aside from, I would say, catch balance type plans for smaller sized plan participants. So we haven't really seen that on the DB side, in the corporate space. That's not to say that is the case on the public side, or also for Taft-Hartley plans. I think the presence there in the DB arena is still quite strong. But with essentially retirement income adequacy becoming more of an issue, more of a central issue, I think that there's been more of a spotlight on the need for defined benefit plans. I mean, we are currently experiencing or living through a retirement crisis, in a sense that and people don't have enough to live sufficiently throughout their lifetime, just from a defined contribution plan alone. In fact, the purpose of a defined contribution plan, when it was invented, it was never meant to be the sole vehicle to support a retirement. It was always looked at as a supplementary vehicle to the defined benefit plan and to your personal savings, in order to allow a person to retire with dignity. And that's not to say the retirement income adequacy is not just a problem for the indigent or even the middle class. It's an expensive type proposition, and I think that people are recognizing it with worldly events, with inflation, with costs rising, that how important it is to have this steady sort of income. In a defined benefit plan, right, you can never outlive if you're getting that lifetime income annuity, you can never outlive that benefit. In a defined contribution plan, there are certain challenges in terms of drawing that money down. And in certain cases, if you are negatively affected based on timing of a poor market return, like in 2022, just to give a quick example, in 2022, there was close to a 20% decline in the markets, right? And so then in 2023, retirees over the age of 70 and a half, typically considered the required minimum distribution age, they were forced to take out withdrawals at essentially the worst possible time. We're taught in Finance 101 that when your investments plummet, that's not an opportune time to take money out of the plan. You want to keep it in there and give it a chance to at least earn some of that back. But you couldn't do that with required minimum distributions, and so many retirees face an additional burden just having a DC plan alone, and they won't be, just based on the timing, they won't be able to ever recover those losses. And we see that many of the the strikes that are going on in public, a lot of times a major issue of contention is the provision of defined benefit pensions going forward. That's a major bargaining chip. And so I think people are realizing the importance of it. You totally realize it when you don't have that benefit anymore when you once had it, or in comparison to a defined contribution plan alone. And so I think that essentially recent events have shed a light on the importance of having it. And it's important to have both. I want to be clear that it's important to have both a defined benefit plan and a defined contribution plan, because it's essentially, you have that defined benefit plan floor where you're never going to run out of income for as long as you live. And you also have a defined contribution plan where you can draw down those assets as you like without fear of running out of money. So I think both plans are quite important, and I'm happy that they're getting the spotlight that they are now.
Yeah, it's unfortunate that, I mean, I understand, like, obviously just from mathematical perspective and investment risk perspective, but, I mean, I think in some ways, one of the pieces of advice I always give, I mean, not related to pensions, because that's not my area of expertise, is I genuinely think that when you don't have a pension, I think it does affect, I don't want to necessarily use the word loyalty, but just how you feel about working at a particular company. Because if you're not promised a particular benefit, then I think in some ways that does change at least the dynamic between employer, employee, and how you think about a company, you know what I mean, over the longer term.
No, that's a good point. I mean, it's no surprise that, with organizations that offer defined benefit plans, I feel that statistics will show that there are less types of turnover type problems than compared to organizations that don't have a DB pension. Defined benefit pension plans were typically used as a tool to essentially offer orderly retirement. Like, essentially, you have your early retirement phase. This is your normal retirement age as defined under a pension plan. And so it's sort of a unofficial guide to participants of how to sort of have an orderly retirement, and also then again be able to retire with dignity.
Got it. Now, coming back to the theme of the episode, we talked about a defined benefit, or DB renaissance, and you were recently quoted in a New York Times article regarding the unfreezing of a major defined benefit pension plan. I think we can say it because it's in public, IBM. I don't think we have to hide the name. Now, you actually just spoke about what it means to freeze a plan. Essentially, is transfer the liability from the plan sponsor typically to an insurer. So a lot of people, I think, historically that's been a very common pattern, I think, in the past few decades. But in this particular case, it's the opposite. They've decided to actually unfreeze the plan. So I don't think we need to cover, like, the unfreezing. If you think of it, it's just the opposite, right? You're just kind of going, but anything you want to add to that? It's just the opposite of transfer.
Well, yeah, I mean, IBM is a very interesting example because they actually froze their defined benefit pension plan back in 2007. And so, as you stated, now they've done the exact opposite action. They have reignited or restarted their defined benefit pension plan starting in 2024. So yes, it would be the opposite. And they're a great example in terms of our risk management review or case study, which I'll be happy to talk about.
Yeah. So actually, I was curious. I read a little bit into what they did. So essentially, and correct me if I'm wrong. So it sounds like from my recollection, it sounds like they had a 6% match before for a defined contribution 401k. Then it looks like they switched that to a cash balance plan where they gave 5% credits, and then I think for the first year, 1% of salary just for the first year or something. Would that be kind of a fair assessment?
Yeah, that's exactly how they went into that transition. Essentially, they were offering just since 2007 or about, they were offering an employer matching contribution, as you noted, 6% of pay through a defined contribution plan. And then starting in 2024, they've shifted their retirement spending strategy from defined contribution to defined benefit. So they have ended their employer matching contribution in the 401k plan. And now going forward, they're offering a 5% of pay benefit through a defined benefit plan. And it's interesting, you alluded to a cash balance plan. I mean, that's really, that is part and parcel with risk management, in that cash balance plans fall under the category of hybrid pension plan type designs. This is a defined benefit plan that has to operate under the rules of under IRS DB rules, but it's made to look like a defined contribution plan. So you have this benefit that's defined in terms of an account balance, just like a bank account. And each year it grows with the plan sponsor contribution and with interest earnings. And so that's essentially how their cash balance plan operates. But really on the employer side, the interesting question is, what were the motivations behind a major corporation, a well-known corporation, and really a pension trendsetter like IBM, shifting their retirement strategy from defined contribution to defined benefit, and why they do it now? So I'd like to touch upon that, if I may. Because I think that's very important to the notion of defined benefit renaissance. So IBM, through the course of investment earnings, and certainly they were helped also by the higher interest rates that we've experienced over the course of 2022 and 2023, their funded percentage was able to significantly improve over the past decade. And they had a large pension surplus in their defined benefit plan. So they are effectively able to use that surplus to fund future benefits through the defined benefit plan, instead of making a cash contribution, which they were doing, which they had to do in their defined contribution plan. And so the move going from DC back into DB for a plan sponsor like IBM, it essentially can save billions of dollars, because you're no longer fixed into making a cash contribution into your plan as long as your surplus is available. So then the question is, well, how long will the surplus go for? It gets into pension risk management, asset liability matching in particular. And so if their assets essentially have matching type fixed income investments that matches the pattern of their liabilities, you could, for quite a long time, be able to maintain that surplus. And so as long as that's available, this is a cashless type of expense, which any corporation would certainly appreciate. And so, on the employer side, I mean, I think that in 2023 and 2024, the economic environment for pension plan sponsors is really a favorable one. You have interest rates at record highs, which on the converse side, that means liabilities are record lows. You have, therefore, pension plans having surplus earnings, okay, which offsets their contribution requirements. And you also have favorable IRS rules in place under the American Rescue Plan Act that was passed in 2021, which essentially allows plan sponsors who aren't fully funded to make up that underfunding over a longer period of time. Previously, it was 7 years, and now you can make that deficit up over a period of 15 years. So you have this trifecta of favorable forces just all coming together. And so that really just begs the question, like, well, there's always a risk for a plan sponsor sponsoring a defined benefit pension. The biggest two being interest rate and investment risk. But if you're able to control those risks, and again, this very opportune economic environment allows for that, one can easily make the case that it would be to a plan sponsor's financial benefit to shift retirement spending from a defined contribution plan to a defined benefit plan. Now, if I were to just reference a comment I made earlier, I mean, I still think it's important to have both types of plans, DC and DB. So, if you're a plan sponsor out there, you don't have to go the IBM route. You don't have to completely end your employer matching contributions. You don't have to go from 6% match to 0. You can go from 6% to 3% and see what that additional 3% shift from DC to DB will buy you in terms of benefits and in terms of your overall risk tolerance, risk management strategy. And so I think it's important for pension plan sponsors, in light of the economic environment, to look at these things as part of their suite of risk management techniques. And IBM in particular is quite a great example, not only being a pension trendsetter, but this is a company that's made use of the techniques available in this risk management spectrum. They've frozen the defined benefit. In 2022, they had a large risk transfer to an insurance company. So they reduced the size of their DB plan. They shed risk. They transferred our assets and liabilities. And then in 2024, they reopened their pension plan to allow for accruals. And they also accompanied that by a plan to have asset liability matching techniques that would preserve the surplus. So IBM is pretty much seen it all in terms of the risk spectrum. So, and it's important to note, because there's not a one-size-fits-all solution, and you don't have to particularly just focus on one type of risk management technique. You can actually do all of them when it's most suitable for you, and really depending on your risk tolerance as an employer.
I'm glad that you put it that way and you talked about some of the drivers. I think one natural follow-up that I have to that is, when you talk about the fact that it's driven partially by interest rates and investment returns, and one thing that naturally comes to my mind is, well, it can't be one or the other. I think it has to be dynamically managed, because we had a recession in the early 90s. Then there was one in 2008, and then who knows when the next one is going to be. And in those cases, I feel like interest rates sometimes go through extreme changes. Obviously, they went down, I think, after the last one. So it sounds like it's fairly dynamic. And on that note, it's a perfect bridge to what I was going to ask next. Is we mentioned that plan sponsors have the flexibility with around defined benefit plan exposure. We talked about freezing, unfreezing. And I think when we spoke the first time, you mentioned that there's a risk management spectrum depending on what they're trying to accomplish. So what options are available to plan sponsors to manage defined benefit plan exposure, or to, whether you want to call it defined benefit plan exposure, just whether it's for that or for the other plans, just their exposure in general?
Yeah, so if I were to look at the risk management spectrum, I would I guess simplify it or break it down into 3 major categories. I would look at risk retention. I would call it then risk management. That's more asset liability driven matching type strategies. And then the third category would be risk transfer.
Mm-hmm.
Now, I'm a big believer that risk management always begins with proper plan design. And so that's where the risk retention aspect comes into play. If you're a defined benefit plan sponsor with a frozen plan, or you don't have a defined benefit plan and you're looking to move or shift benefit spending or your strategy in the DB arena, I would say you certainly don't want to look at what was called a traditional or dinosaur type pension plan formula. One that was based on, maybe final average earnings. Those plans, history repeats itself. You mentioned how interest rates were down and then higher. You have to learn from the mistakes of the past, and also from how pension plans can get very costly depending on how they're designed. And so you wouldn't want to start with a final average pay type of design, because those designs are highly leveraged on pay and service. You would want to start with a hybrid type of plan, such as cash balance plan like IBM's, or a variable annuity plan where the liabilities can be adjusted based on how the plan's assets perform. That's the risk retention side. The sort of what I call the risk management type of side is you want to look at essentially your funded status. That's sort of the most important thing, not assets alone, not liabilities. And so what many companies are doing is, as their funded status improves, they're shifting asset allocations from equities into fixed income. They're doing that in a way to match their liability payout structure with their asset portfolio. A perfectly matched plan is agnostic to interest rate changes and investment returns, because if interest rates were to fall, your liabilities increase, but so would your plan assets in a perfectly matched scenario. And on the flip side, if interest rates are to rise and your assets fall down because you're holding fixed income type instruments, your liabilities would also fall, because after all, your liabilities are based on a corporate bond discount curve. And so as long as assets and liabilities are moving together, you're taking away the risk, the two major risk exposures, which is interest rate and investment returns. And so as your plan gets better and better funded and then into hopefully surplus funding territory, at that point, your goal as a plan sponsor should be really to focus on maintaining that surplus as best you can. Pension plans have what's called an asymmetric risk. Basically, if you're 105% funded, but your funded percentage then falls 5 percentage points, and you fall back under the 100% level, sort of bad things, requirements start kicking in. Insurance premiums, quarterly contributions, additional funding type measures. Versus if you're 105% funded and you have a 5% improvement, you go from 105 to 110%. Well, not much changes. You just have a bigger surplus. It's not like that surplus is going to revert back to the employer. It can, but there's lots of hoops and technicalities to go through that, including a 50% excise tax, not to mention the additional federal, state, local taxes that would be attached to any surplus that would revert back to the employer upon a plan termination. So because of this asymmetry, it's very important to focus on funded status and sort of a matching type of strategy. There's different ways you can do it. You can do a duration matching strategy on the simplistic side, or you can do a fully dedicated strategy where you're matching cash flow per cash flow that's expected to be paid out to participants. You're matching that with a corresponding asset base. The third category in the risk management spectrum, again, I'm simplifying, but is pension risk transfer. Pension risk transfer has certainly made the headlines over the past decade. You've had some particularly large transactions for some prominent employers like GM and Verizon. That's essentially where the plan sponsor determines that I want to transfer a portion, if not all, of my liabilities to a third-party insurance company. And you also have to transfer assets as well. Now, just so some background on this, the original intent of the pension risk transfer, it was really focused on retirees, and in particular, retirees with smaller liabilities or smaller accrued benefits. If you're sponsoring a pension plan and you have a block of retirees with very small benefits, perhaps they were short-serviced employees or lower-paid employees, what have you, but if you have very small accrued benefits, pension plans sponsors also have to pay insurance premiums to the PBGC. Based on how basically interest rate mechanics have evolved, you could end up in this weird situation where you're paying more in insurance premiums than the actual value of the benefit that you're insuring. In situations like that, it just makes economic sense to get these types of accrued benefits off the plan sponsor's balance sheet. And so that's where the notion of risk transfer really started. Then it evolved to, well, how about I do a risk transfer for a larger group of retirees? And then the ultimate risk transfer, again, for a plan sponsor that has little to no risk tolerance, would be terminating the plan. So, depending on the state of the business, the plan sponsor's risk tolerance, there are many different ways you can go. But I also say this, that, risk management comes at a cost. You're de-risking, but you're essentially making a prediction of how the future will hold. Whenever you're reducing the size of a plan, if you're doing a risk transfer and transferring liabilities and accompanying assets to a third party, the assets leaving the plan, that's quite important, because if you were to do that at a particular time, you're potentially missing out on present value of future earnings growth. And so, if you did that prior to 2023, you would have obviously missed out on the run in the markets where we had double-digit returns in 2023. So you have to evaluate carefully if you're engaging in a risk transfer, what size of liabilities is appropriate to transfer to a third party outside of the plan, and then what is the true cost of doing a transfer. You're generally going to be paying more in assets than you are releasing liabilities, because if the insurance company is taking on that risk, they have to guard for adverse risk in the future, anti-selection. They're also profit-making entities, right? So they have to build in certain margins and certain assumptions to protect that. And so, you really have to evaluate that carefully to see, what makes the most sense for you, again, based on your risk tolerance as a plan sponsor.
Great response. I think one good example you had used before is you said when, for risk transfer, plan termination, there's a couple of fundamental options, a lump sum and the annuity. And then you mentioned anti-selection. I think you were saying that the healthier participants would choose the annuity, or would be inclined to choose the annuity, and those in poor health would be inclined to choose the lump sum. So that's a dynamic that they have to manage when they're making that decision.
Right, absolutely. And so anybody who's getting, who's having the risk transferred to them, they would have to balance against that anti-selection. So they're also, risk transfer costs are also based upon, what kind of options are available under a pension plan, and what types of benefits they're allowed, how subsidized they are. And then they have to make an assumption about, participant behavior, which is often anyone's guess. And it also changes based on where you are in your lifetime, with respect to retirement, and then also economic factors like interest rates, for example, and inflation or cost of goods.
Now, one last thing I wanted to ask about is more specific to the annuity purchases and what trends you're seeing in the market regarding annuity purchases.
Well, annuity purchases continue to be to essentially show volume. I think that they've gotten a little more expensive so far in the first quarter of this year, just based on some prevailing data. At some point when interest rates, maybe a couple of years ago, a lot of the transactions for retirees were, I guess, what's called on par. So essentially, the assets were very close to the liabilities that you were giving up to transfer retiree liabilities to an insurance company. retiree liabilities typically are the most predictable source of liabilities in a pension plan. Unfortunately, there's only one thing that can happen to retirees, right? Typically, and so that's how the valuation type works. And so, to the extent that a plan sponsor is shedding their risk by getting rid of retiree liabilities, you have to keep your eye on the entire picture here, because if you're getting rid of your most stable source of liabilities, you are then in fact making the remaining plan more sensitive to interest rate risk, duration risk, and so funded status volatility. So you have to carefully look at that. But with that said, certainly risk transfer is still happening. And again, as I mentioned, I think the cases where it makes the most sense has to do with premium savings, PBGC premium savings strategies, and where the benefits you have on hand are small compared to the premium that you're paying. I think that right now the current rules for determining PBGC premiums, a lot of the rules are essentially headcount based or based on the funded status of a plan sponsor. They don't necessarily take into account the type of design that the defined benefit plan sponsor is having. So, certain designs are more riskier than others. And so I'm hopeful that, that some of these changes to the determination of PBGC premiums that are essentially being discussed by the American Academy of Actuaries and also the Senate Help Committee chaired by Bernie Sanders. I'm hopeful that some of these changes can be made to PBGC type insurance type calculations so as to preserve or basically reduce the burdens on defined benefit plan sponsors that are really providing a valuable benefit, not just for their participants, but for society in general.
So just a quick summary of that from what I heard, based on what you're implying, is that there's less of the large transactions and a lot of the smaller ones where economically it doesn't make sense to maintain it given the PBGC premium. Would that be a fair assessment?
I think that so transactions are happening in all extents, but I think that that's a good place to start. If you're having that discussion, if you're considering it, then I think that that's certainly a lot of these transactions are based on getting the smaller accrued benefits off of your plan, and that's and of course also the ability to save on insurance premiums. I think that often precipitates that conversation.
Okay. Well, I felt like I learned so much in this conversation. I haven't done pensions in a while, and we haven't had many episodes on this might be only the second episode on pensions, but this was extremely insightful and enjoyable conversation. Hopefully you had a little bit of fun as well.
No, I did. I'm happy to talk about DB pensions and raise important issues, because I think they have a valuable purpose in society. And I'd like to see continued risk sharing between plan sponsors and plan participants, and also recognition in the pension plan rules to essentially look at reducing certain burdens on plan sponsors that decide to use this type of benefit for their retirement strategy. So it's again, thanks for having me today, and it's been a pleasure discussing this with you.
Well, it was my pleasure, and thank you so much, and wishing you a wonderful rest of the day. Thank you.
Thank you.